Hi everyone, I'm Brandon Averill, one of the partners at AWM, where we advise people in creating multi-generational flourishing families so that we can solve that shirt sleeves to shirt sleeves financial epidemic. And this is a front row seat with AWM's Chief Investment Officer, Justin Dyer, and myself, as we discuss some of our clients' most pressing financial questions. This is AWM Insights, and let's dive right in. Hey Justin, welcome back. Got a good topic to dig in today. We're gonna get nuts and bolts a little bit and talk about, we've talked about investments, what those actually are, but let's get in today to, great, I want to invest my money. What am I buying, I guess is the better way to put it. So it's gonna be, hopefully we'll bring some clarity for everybody here because the universe is awfully big. So I'll throw it over to you. I want you to start, maybe even just start at the basic level when people think about investing, buying ownership or buying, going out and lending your money. Where do we start?
Sure. So I love our format so far this year. We're just slowly peeling the onion, as an old colleague always used to say. And the more we peel the onion, or I peel the onion, I get to nerd out a little bit more. We'll try and keep it high level throughout these initial podcasts, but definitely want to, at the outset here, if you guys have questions, topics you want to discuss, by all means, let us know. I think we're going to tackle one we got some feedback on next week. So a little teaser there, but so owning versus lending is what we talked on last week. And then really we're talking about the vehicles in which you can take those two general paths with respect to investing. So start really at the top, which everyone's probably really familiar with this. At the very top, you have stocks and bonds. Those are synonymous with what we really dug into last week. Ownership are stocks, lending are bonds. If you're buying a bond, effectively what you're doing is you're lending money to some kind of entity or institution or person in some cases to do something with it. If you're buying a stock, that represents direct ownership in if you're doing it on a publicly traded exchange, you're buying a publicly traded company. So think about the big names that are always out there in the news: Apple, Microsoft, Ford, Tesla. These big company names that you hear most commonly are publicly traded stocks. If you're going to your brokerage account, we'll probably touch on actually how you can get access to these in some future episodes, and pros and cons and how you trade them, et cetera, et cetera. But if you're in your brokerage account and you're buying a share of Apple, you actually are buying a very small ownership in that company directly. Last week, we talked about what does ownership mean. You actually have a claim on future profits. Really, at the end of the day, is what you're looking at as a company owner. Again, really, this is the basic building block. On the bond side, won't get too granular here, but you can take different forms of loans. You can loan money to government. So U.S. Treasuries, that is a bond. You can make loans, or you could go buy bonds for the state or the municipality which you live in. You can buy, I'm in California right now. California issues a number of different municipal bonds are what they're called. Companies at the same time also issue bonds. So Apple has bonds that trade on the public markets. Microsoft does. Pretty much any publicly traded company takes advantage of both issuing stock and issuing bonds to help fund their operations in one way, shape, or form. They do an analysis to see what makes sense, which route to go. But that's what a stock and a bond is effectively. There are hidden costs to ownership of these vehicles. So when you go and you do try and trade one of these in your brokerage account, or even if you go to something like Yahoo Finance and look up a quote, you can see that there's actually what's called a bid price and an ask price. And really the difference between those two is what's called the spread. And there's a cost there. There always is a difference. And really what those two numbers are saying is what people are willing to buy the stock for and what people are willing to sell the stock for. And generally speaking, what's quoted is the last price that a transaction actually happened. That's not guaranteed to be what you would get if you went in to go buy that. You might there might be some news item that hits the market right away and the price drops. And if you're buying it at that point in time, there are ways to protect against that, but not going too deep there. If you're entering an order right there, the price may fall and you might actually have a greater spread to your transaction. And that is effectively a cost to you. The great thing about the world in which we live in is access is incredibly broad, incredibly easy. It's very straightforward to open up a brokerage account, to transfer money into it and start investing in stocks and bonds and other vehicles, which we'll get into. So real basic stocks versus bonds, ownership versus lending, which we touched on. But the real cool thing about where we are today, and this isn't new, but it's continued to evolve and really the innovation has sped up quite a bit, is within commingled vehicles or pooled vehicles. The most common or kind of longest lasting pooled vehicle is on the mutual fund side of things. This dates back, I don't know the date exactly, but I think the first mutual fund goes back to like the 1940s, maybe even a little bit beyond that.
40 Act, right?
40 Act fund. Yeah, there you go. You're right. So it's not a new innovation. It's been around for quite some time. But the genesis of it was, hey, you know what? There's a benefit to being diversified in your investments. Let's pool our money together. And quick teaser or reference back to this whole bid-ask spread. By pooling money together in a larger amount than you as an individual have, you actually get more efficient participation or access or execution into the market that you're trying to participate in. So, let's just say you want to buy the S&P 500 or some other list of stocks. Pooling your money together probably gives you a little bit more efficient access to that, or it gives you more scale. So if you didn't have enough money to access all 500 stocks efficiently, by putting your money together with other individuals, you then have more money and you can actually go and get access to it.
And I think, right, the big impetus around this was the realization, and the data supports, right, that you're going to have higher risk adjusted returns, more representative returns, if you're not exposing yourself to single company risk. So back to the stocks that you just reviewed, we often, as we're starting out investors or we're kids, we're given the assignment, maybe even in school, pick the 10 stocks, and we're going to play this game. And, unfortunately, it's a pretty silly exercise because nobody actually lets you just buy the diversified portfolio, which we know, at least statistically outperforms over longer periods of time. But that was the purpose of these vehicles in large part, right, Justin, was to bring more efficient access to a higher expected return kind of pool of assets, as opposed to just exposing yourself to the 5 companies that because you're familiar with their products.
Exactly. Well, and again, going back to when these vehicles were originally or gained much more popularity, I believe there were commingled or pooled vehicles even back into the Great Depression. It was much more common for individuals to participate in a single stock or a handful of stocks. And hey, guess from the 28, 29 period all the way through World War II, it was a tough time in the market. And yes, to your point, Brandon, people did realize that, hey, don't put your eggs in one basket. Diversification is, effectively the one true free lunch out there, if you will. If you want to call it that. And so, yes, diversification has all sorts of other benefits that drove the innovation and adoption of these commingled vehicles. The other piece with respect to mutual funds, and then we'll jump into exchange traded funds, which are very similar, but they have some nuances. The interesting thing about mutual funds is they don't trade throughout the day. So like a stock, you can buy at any time during market hours. So market hours being 9:30 Eastern time up to 4 p.m. Eastern time. You can go in and buy and sell a share of Apple at any point in time throughout that day. Mutual funds, you put in an order, you say, I want to buy $10,000 of this mutual fund. That actually doesn't happen until the close of the day. And so you get one price. It's called the net asset value, whether you're buying or selling. So it's an interesting distinction there. ETFs, exchange traded funds, a lot of innovations happening here, and kind of much more of a new vehicle. I mean, they've still been around for quite some time, multi-decades in most cases, but there's been an infusion of new ETFs available really in the last 10 years. And you're even seeing an acceleration further over the last 2-3 years even. An exchange traded fund, it's a pooled vehicle, just like a mutual fund is. For the sake of our conversation, we'll just summarize one of the key differences really is that it's traded throughout the day as opposed to the very end of the day. It does bring up some additional benefits with respect to transaction cost as well, which we actually really like that aspect of it. Whether it trades throughout the day versus the end of the day, for a long-term investor, doesn't really matter all that much. If you're buying something for the long term, if you can buy it at 10 a.m. in the morning versus 4 p.m. in the afternoon, shouldn't really matter or be all that material to you. And that's kind of what our general take on it is. And really what's been changing with respect to ETFs from a reputational standpoint is that traditionally they've always been these cheap index focused products. So like Vanguard or an S&P 500 ETF. iShares is a big ETF provider as well. The original ETF was launched, I think it's the original ETF, I shouldn't say that definitively, but State Street actually launched their SPDR. It's called S&P Depository Receipts is actually what that stands for. Launched those, I want to say 30 years ago or so, and that was the first real popular large scale ETF. And iShares, going back to there, have really benefited BlackRock, which is the parent company that owns iShares, and shot just recently. BlackRock released their earnings, and largely because of iShares, their ETF business, they now sit over $10 trillion of assets under management, which is an insanely large amount of money, but really on the back and the success of their iShares business.
I'm glad you hit on the reputation there, Justin, because I think this is a really good point to make it, because we hear it all the time is, people have strong feelings about mutual funds or ETFs. And I think they come into it with that reputation in mind that mutual funds are expensive and oftentimes actively traded, meaning, that there is a manager there that's like, trying to read the tea leaves and make predictions. And I would say that might have historically been correct, but what we've seen certainly out over the last, number of years is that's completely changed. And I think same on the ETF side. I think one of the key takeaways we'll hit on at the end is the devil's in the details. And all of these, I would say that's true. And it's no longer such a simple distinction. There are a lot of mutual funds out there that are managed fairly tax efficiently. They're super cheap. They're index based, and they're really, really good vehicles for investors to have in their portfolio. And on the other side, ETFs, there are actively traded, very expensive ETFs out there now. So really, these are just wrappers, and there are nuances, but they really are just vehicles. And I think blindly saying, like, I'm going to go buy an ETF because it's cheap, like, you better look to see what the expense ratio is. I mean, we've seen a number of portfolios that people think that they're getting one thing and it's something completely else. So, I just think it's really good for people to know that, and that you do need to look inside to see what you're actually buying, and that mutual funds aren't bad or good. ETFs aren't bad or good. You really just need to evaluate the individual characteristics of each of them to determine what fits in your portfolio more effectively.
Yeah, that's a great point. And there is really a convergence between mutual funds and ETFs and the available strategies within each vehicle or within each type. But to your point, the devil really is in the details. You need to dig into it, speak with your advisor, really understand how it operates, what it does. This is getting a little bit into the derivatives side of things, which derivatives are another vehicle. I'm jumping ahead a little bit, but it's another vehicle. But you can actually have derivatives within a fund structure. And some people see a fund, ETF or mutual fund that says like S&P 2x return or something like that. And that fund is basically holding the S&P, but it's using these derivatives to turbocharge the exposure. And then the nuance there, and I'm totally not sticking with our plan to keep it high level, but I want to make this comment. The nuance there is what actually generally happens in those vehicles is they reset the portfolio on a daily basis. And the performance ends up being completely different than what people understand as like just the simple marketing name of they're just like, oh, I'm going to get 2 times the S&P 500 return. And again, devil's in the details. Sorry to go a little in the weeds there, but it's very, very true.
I'll keep us off tangent. It's almost never the case too. You're always short that 2x. They very rarely get that right. And then B is if anybody wants the cheat code to derivatives, and I know we're going to hit on this in a little bit, but go queue up The Big Short. It's entertaining to watch, and you can see the impact of derivatives when they spin out of control. So, derivatives are just contracts, and they can certainly introduce an element of risk. We saw that with Robinhood last year. Everybody thought they owned crypto, and they quickly found out, oh, actually, Robinhood, you don't actually own the crypto. It was Robinhood, right? Yeah, you don't own the crypto. You own a derivative or a contract on the crypto. So anyways, we can get back on topic, but
so one more pooled vehicle that I think is pretty important to touch on. There's the private side of things as well, but one more pooled vehicle that really touches on more of the public side is the term hedge fund. Hedge funds also have been around for quite some time. I want to say very similar to mutual funds. Traditionally speaking, they were what the term actually implies. Is people out there wanted to hedge their risk, hedge their exposure to the broader equity markets, S&P 500, Dow Jones, industrial average, whatever the case may be. And so what they would do is they would put some sort of hedge in place, and I'm not going to go into what that might exactly mean, but just essentially think about they wanted to protect some of their downside or protect some of their gains. And that really started the hedge fund industry. Fast forward to today, a hedge fund, the term hedge funds does not necessarily represent a single strategy whatsoever. Really, the simple kind of definition or explanation I would give to that is it's a commingled vehicle. It's a commingled fund. There are some that trade publicly with some restrictions, generally speaking, but they do trade on public markets where you can buy and sell them. But they're generally riskier and or uncorrelated with the overall market. You're taking a lot of what's called manager risk. So you're basically, instead of saying, hey, I want to participate in the growth and the power of markets overall and what they have done over the long term, you're saying, no, I'm actually more putting my risk, stacking my risk, and hoping I'm being compensated for the risk, the weight I'm putting in this manager skill to hopefully outperform. Data doesn't really support it. A little teaser there. And the data is kind of weak with respect to them, but they are out there. They've been around for some time. It's a very nebulous term, and there's no one size fits all definition. You can see so many different strategies within that broad classification. And again, it can be a publicly traded vehicle, meaning you can go buy it within an exchange, or it could be more of a private fund type structure, which is another aspect, and we can touch on that. And Brandon, maybe you can jump into the private side of the marketplace.
That's a great transition, because most of what we've been talking about, purchasing individual stocks, individual bonds, those can be done on the public and private, but we talked about them mostly in the public sphere. So public, again, meaning that access, we can all log on to a computer. We can get access to these different exchanges where these companies trade publicly, and these
and highly regulated.
Exactly. These commingled funds trade, publicly, and almost everybody has access to them. They're highly regulated. And this is where we've talked about in the past. We'll talk about a lot more in the future. on that public side, all information is available to everybody. There is no information advantage. If you want to seek out that information, it is available. And what we know is that markets, do reflect all available information. And so there's very strong evidence of that. But kind of as we work down the structure standpoint, and get beyond the commingled funds, all these types of vehicles exist in the private markets as well. But with the private markets, not nearly as regulated, although they're starting to try to do a little bit more of that. But this is really where, private companies don't have to share their information with everybody. And so you can have the same relationships. You can go buy ownership or stock in privately traded companies. You can go lend money to privately traded companies as well. But the information flow is more, it's not as available. So it really is who you know, what your access is, how willing the company is to actually reveal that information to you. There are private investments we made that we have a lot of information on. And if other people called up the company, they're not going to give them that information. So theoretically, we might be able to arrive at a better price. There are companies that, we don't have access to that information and other people do. They're going to know more about that. So, as we move through, you definitely can go buy, if you go buy the stock individually, if you go lend the money individually, that's what, the private industry refers to as directs. That meaning that you're directly going to those companies and entering into an arrangement with them. And then there's the commingled side. And this is where, it's pretty simply just access to funds. These are typically run by venture capital companies. So there'll be a general partner that's running these funds or private equity groups that are running these funds. So what a fund does is the same concept. It's going to then, you're giving your money to a manager. That manager now is going to go out to the market and buy direct allocations to different companies or lend to different companies. And those get aggregated. And you, as the investor, now get broader diversification to a pool of investments as opposed to trying to figure out, hey, this is the one direct opportunity that I want to go to.
And I would say there's an important distinction too in size. So there was a headline today or yesterday, I can't remember when I saw it, about Blackstone, big private equity group. They have a record war chest on hand, and they're on the search for deals here. And that is, they have so much capital. They're not going to go put that into small startup companies. They play in a specific area of the market, private equity. Maybe they're trying to buy out large companies that they feel like they can improve management on or something like that, where to your point on the venture capital side, or as you reference venture capital, they're a little bit more nimble, writing smaller check sizes to these startups to get the business really off the ground. Higher risk, higher return, but interesting tie back to kind of maybe some names you'll see in the news, right? Blackstone, big private equity group. Andreessen Horowitz is a big venture capital firm. They were in the news 3 weeks ago with a big crypto fund, venture fund that they're trying to raise. But these funds are generally on the venture side a lot smaller than they are on the private equity side, kind of for logical reasons.
Yeah, and they certainly get a lot of the headlines because it's, again, going back to your comment, I mean, the expected return for these vehicles better be high because you're taking a significant amount of risk. They also generate a lot of the headlines. And I know that'll be the next step, is to get into, the next step is, okay, we kind of gone over some of these high level things, but how do we actually get access to them? Like, okay, we'll talk about how do you actually buy a stock on the public stock market? How do you buy a bond on the public stock or public bond market? If I did want to participate in private, how do I go about doing that? And we'll get into all that in a future episode. But we are definitely going to take a deviation next week, and I think we can riff on this a little bit too to tease that out. But I'll ask you, Justin, we've heard blockchain and crypto and NFTs and this whole world going on. How does this play in, right? I mean, I think last week we pretty much put to bed the idea that these are investments, because most of them we don't have any way of figuring out future cash flows and coming up with a price. But they are. I would say that's probably too simplistic of a look, to be honest. I'm just kind of curious from your perspective, and I guess I'll cut to the chase. We're going to do an NFT episode next week because the flood of questions we've been getting, and it was definitely requested by a good friend of ours. I'm sure he's listening right now, so it's coming. But how does it tie into just the market, Justin, and access to these things, and like what's the vehicle, and maybe just give a 2-second highlight because we're going to get deep into it next week.
Yeah, and I think I'd go back to really what we've hit on a couple times, and I think is even the summary of this episode is that the devils really are in the details, especially with respect to, let's call it Web3, which is a still, I think, still to be defined term. I mean, people are using it really broadly speaking for NFTs, crypto, blockchain, DeFi, all these terms that are being thrown out are kind of being aggregated into this Web3 topic, but the devils truly are in the details. There's a lot of hype around cryptocurrencies specifically, and a lot of people that are taking advantage. I think the jury is definitely still out on what a cryptocurrency is. It's not an investment at this point, and not saying that in a bad way. It's a speculative journey, I guess, if you will, that you're leaping into if you're participating in that. There's some arguments about what let's say Bitcoin is or isn't. And again, I think the jury's still completely out on that. Just a quick kind of teaser on that. Again, I'm not giving you a short answer, but I'm trying to tease this stuff out where, everyone said, oh, Bitcoin's going to be a great inflation hedge. Well, guess what? That's argument's been shot in its foot. Doesn't mean it will in the future or won't in the future, but it certainly isn't right now. NFTs, I mean, this one really is in the details, and we will get into this. It's really hard to know what you actually own. There's a ton of, again, using the term hype that's driving excitement, but I don't really think people understand the underlying technology quite well, understand the efficiency, understand the cost of this entire space. There's a lot of work to make it more efficient, to make it better understandable. But boy, I did a deep dive on the technical front of it a week or so ago, and we'll tie into some of those topics when we dive into it ourselves. And there's a lot of work that needs to happen to, I think, catch reality up to what people think is actually truly going on, and why what people think they're getting, and why they're spending, in some cases, ridiculous amounts of money on pictures of gorillas.
Well, I think the other thing is, to be fair, and we'll get into this aspect too, is conceptually there's some really cool potential applications of it too, right? It's a shift to creators actually getting compensated in the right way, and I think that's why this is getting traction, right? And so I think it will catch up. I think we can confidently say that. Trying to predict which one and all that's going to be really difficult, as with anything. But we'll cut it off there. We'll jump into this next week. We got a lot of work to do to make sure that we can distill down at least our take into a nice little succinct episode, and at least generate some insight for everybody that does take the time to listen. So, but we'll close out today. Hopefully this was helpful, just giving a landscape of how do you actually go, or what do you actually go buy when you're ready to invest your money. And we'll take a deviation next week on NFTs, but then we'll jump back in with, okay, great, we know what to buy now. How do we actually go buy it? Where do we actually go buy it? But until then, head over to awminsights.com. You can, a couple downloadable resources, as you all know. We would love to know your thoughts. You can drop us a note, give us feedback. That'd be great. But until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.